We'll just get started. So, good morning, everyone, and thanks for joining our Junior Energy In-House Lawyers webinar series today. My name's Kendall. I'm a senior associate in the banking team here at Burness Paul, and today I'm joined by my colleague Dorney, who is a senior solicitor in our banking and funds team. So, before we get started, just a bit of housekeeping. Once you've joined, please can you ensure that your mute button has been selected to limit background noise. And please note today's webinar won't be interactive, so please just do contact either of us or any of your Burness Paul contacts with any follow-up questions. Our contact details will be provided at the end of the webinar. Today's webinar will be recorded, and if you have any queries on that, please do check out our private policy, which is available on our website, Burness Paul's website, and you will receive the recording of this session over the course of the next day or so. So, moving on to our topic for today. Today, we're going to give you an overview of project financing. The intention is to give you a broad understanding of what it is, how it works, and hopefully it will help you in your future project financing endeavors. So, by way of brief introduction to us, our team have pretty significant expertise in financing in onshore and offshore wind, battery storage, hydro, marine and solar, and we've been involved either on the funder or developer side of every offshore wind project which has been developed in Scottish waters to date. So, moving on to what we will cover today. We're going to work through what is project finance, the key characteristics of a project financing, the structure of project finance transactions, and I'll take you on a bit of a run through of that. And a brief, but very brief, don't worry, overview of documentation, including some of the key parties. So I'm now going to pass you over to Dorney, who will give us an introduction into today's topic.
Thanks, Kendall. Good morning, everyone. So, what is project finance and where is it used? Project finance is used to fund a wide range of different asset types. Traditionally, it's been associated with large-scale, long-term infrastructure or industrial projects, things such as power plants, highways, mines, or major transport assets. Increasingly, though, project finance is being used to fund energy and wider infrastructure projects, particularly in the renewable space, where large capital investment is required upfront. If we take an offshore wind project as an example, it should be clear that this type of project is highly capital intensive and carries a significant level of risk, particularly during the start-up and construction stages. From the outset, the vast majority of the funding will be provided in the form of debt, with a smaller portion coming in as equity from the sponsor, that is to say, the ultimate owner of the project company. Another key feature of project finance is that at the point lenders agree to provide funding, the project itself often yet doesn't exist. The project company usually has no physical assets and no trading history. Instead, it has rights under a suite of key contracts. For example, construction contracts, operating agreements, and offtake arrangements. In effect, these contractual rights are the project's primary asset, and these contracts form the foundation on which the financing is built. So, what does project finance actually achieve in practice? Firstly, it enables projects that are expensive and high risk to be funded, where other financing structures simply wouldn't be viable. In many cases, project finance isn't just an option, it's the only realistic way to get a project built. Secondly, because lenders can only be repaid from the project's own cash flows, lenders focus very closely on how the project is going to generate revenue and whether that revenue will be stable and predictable over time. Finally, the structure allows for a higher debt to equity ratio than would otherwise be available. This gives sponsors additional financial flexibility than they would typically have under a standard corporate financing model. I'm now going to pass you back to Kendall.
Thanks, Dorney. So, in reality, no project finance transaction is exactly the same. As with many commercial transactions, each is going to have its own quirks and considerations. But there are certain key characteristics of a project financing, which I'll walk us through just now. So, firstly, project financing is finance raised against the income from a project. This basically means that financing is sized against and repaid from the revenues that the finished product generates. Unlike traditional financing, you can think of this as the lender is basically lending to a project rather than a company here. The focus of the decision to fund, as well as the security package and lending documentation, almost solely revolves around the project and not the companies involved. Secondly, the recourse of the lenders is limited to the project assets and the assets of the project company. This is what we will keep referring to in this webinar as limited recourse. So this ties into point one and is one of the key characteristics of a project financing, which separates it from other types of financing structures. The borrower in a project financing will most often be a special purpose vehicle, usually referred to as the project company, which again is what we'll call it going forward. I'll go into a bit more detail about why that is relevant and really key a bit later on when we work through the structure. And thirdly, as Dorney mentioned, it's generally used to build assets or to refinance the projects, which may be for various reasons, including cheaper costs during construction or once the project is operational. So while I mentioned this on the previous slide, we just want to hammer home the significance of limited recourse, as it really is one of the key things to take away from today and one of the main distinguishing characteristics of project finance in comparison to other financing structures. So, the premise of project finance is that the lender's recourse is to the project and its revenues. The recourse of the senior funders to the sponsors is limited, and there will be no general recourse for lenders to the sponsors' assets. On the other hand, as the only entity generally in the structure with any corporate worth, the sponsors are expected to commit a minimum amount of equity to the project, which again we'll talk about a bit more later on. The agreed equity amount is then ring-fenced in the project company, along with the lender debt, with returns to sponsors being very tightly controlled. This means that the natural consequence of the lender's recourse being restricted largely to the project means that predicting the revenue and income that the project is ultimately going to generate is really key. The lenders are relying heavily on financial projections and a few key contracts to size the debt and predict the likelihood of repayment of the debt. Sponsors will also want to know that the project can ultimately pay a return on equity in addition to servicing bank debt. So this leads us nicely on to Dorney talking us through a little about the pre-financing process and diligence from a lender's perspective.
Thanks, Kendall. From a lender's perspective, comfort in project finance transactions is built around a small number of core elements. So I'm going to take you through them. First, we've got the financial model. This sits at the heart of the risk analysis. Lenders rely on forecasts of revenue and costs to form a view of how much debt the project can realistically support and whether the project company will be able to meet its repayment obligations over time. This is very different from traditional corporate lending, where credit decisions are often based on the wider group's balance sheet, profitability, and overall financial strength, rather than the performance of a single project. Next, we've got due diligence. Lenders carry out intensive and detailed DD on the project, typically covering legal and political risk, environmental and social matters, insurance, tax. This work, together with the financial model, is used to assess whether the project is worth funding. Lenders need a clear understanding of any issues that could impact their security position or the project's ability to generate cash. Next, we've got the debt to equity ratio. So this is another important way lenders get comfortable through the project's debt to equity ratio. That is to say, the bank debt against any sponsor equity. Sponsors are required to invest equity either directly into the project co or via a holding company structure. This ensures the sponsors have meaningful capital at risk and are aligned with the project's long-term success. Although project finance structures typically allow for a higher proportion of debt than corporate financings, the precise ratio is still negotiated with lenders and reflects the project's risk profile, From a lender perspective, this equity contribution from the sponsor is another key risk mitigation tool. The sponsor's equity is exposed first if the project underperforms. This helps ensure that the sponsors remain fully incentivized to support the project throughout its life. Finally, we've got the underlying contracts, which we've been mentioning. So, in most project financings, the project's revenues are rooted almost entirely in its contractual arrangements. As a result, the project is only as strong as the documents that underpin it. At the time the project finance, at the time the project company enters into any financing, these contracts are often the sole material asset of the project company. For that reason, as I explained, DD in project finance is particularly focused on contract terms. This will include, for example, any completion obligations on contractors, mechanics for price increases, changing costs, whether any key contracts can be assigned to lenders as part of the security package as well. Kendall is now going to take us through an example structure chart to explain the key players in a project finance transaction.
Thanks, Dorothy. So, what does a project financing look like? We've mentioned a couple of pieces of the puzzle already, so my hope is that talking through the structure is basically going to pull everything together. You may have noticed that most everything we've spoken through ties back to the structure and why the project is structured in a certain way. So if you remember anything from this webinar, this is probably it. Because a project finance couldn't be a project finance without this or close to this kind of structure. The key risk, as mentioned, is around the certainty of the project company's income. So the project is structured so the financing gives the lender access to as much of the project with as little hurdles as possible. So starting off with our first couple of entities, which we can refer to as the central companies in the structure, we have Project Co, which is our project company, which we've been focusing on. It is our centerpiece of the whole structure. This is most often a newly incorporated SPV, which I earlier referred to as a special purpose vehicle, which just means it's set up for the specific purpose of running the project. An SPV is always generally a company set up for a specific reason only, for example, most commonly to own other companies or to own specific assets, like operating a project here. The key feature of the SPV in the context of a project finance is that it is a clean company, which means it has no employees, no assets or liabilities other than those directly connected to the relevant project. This means it's easier for the lender to assess their risks, and it also makes it easier for them to take security over the whole project, essentially just by taking security over the project co from our holdco, which I'll come on to in a minute. A couple of other key points to mention in respect of the project co. So this is where our bank debt goes in, which you will see designated by our little funders box here, and the arrow is pointing back and forth to Project Co. This is what we would call the senior debt, as repayment will be prioritized to the debt funders ahead of any equity or sponsor debt coming in. Project Co is also usually the entity that gets the regulatory consents and authorizations for the project, again, just so everything sits together. This will be important from a lender perspective so they can easily capture the whole project and any related rights in their security in one place. So moving on to our holdco, a holding company, usually very creatively referred to as a holdco, is interposed between the project company and the sponsors. So this might be an existing company or a company set up for the specific purpose of owning the project co. We would generally see a holdco in a project finance structure in place between the project co and the sponsors as another way to separate the sponsors from the lender's recourse to the debt. As you can see, this ties us back to our limited recourse principle I spoke about earlier. A couple of things just to mention for our holdco. So they will generally grant limited recourse security over, firstly, the shares in the project co. This is really important from a lender perspective because it means they have the ability to take control of the project co, and by virtue of that, hopefully, the whole project. And second, they'll grant security over any subordinated debt. So, as mentioned, equity or subordinated debt will flow down the structure from the sponsors to Project Co through HoldCo, which will also make HoldCo a subordinated debtor. But for the purpose of this training, this is just useful to be aware of in terms of HoldCo's role. So, moving on, you'll see sponsors have appeared at the top here. Dorney has already spoken us through the equity position and the high debt to equity ratio and how this works and why. So just for the purpose of talking through our structure here, it's worth flagging that generally any equity and also any debt from the sponsors will be subordinated to the senior debt from the funders, meaning the senior debt is prioritized. And as I mentioned earlier, returns to the sponsors are tightly controlled. There will typically be a fixed cash flow waterfall in the main finance documents, which allows for a return to sponsors once the project is built and as and when sufficient revenues are generated. Then finally, to fill out our structure here, we have the contract parties along the bottom. So some of the key contract parties in a project finance are shown here. So we have some of the key suppliers, contractors, and of course, landowners. These contractors are the entities who undertake the work to develop and or operate the project on behalf of the project company and the sponsors. And of course, there will be one or more landowners who lease the project site or sites to the project company. Finally, red circle has shown up here. So this is a little visual of our limited recourse group for the senior funders, just for you to paint that picture in your head. And also in case it's ever helpful for you to refer back to, as you'll get these slides circulated. So hopefully that illustration was helpful to for you making sense of the structure. Dorney's now going to talk us through the standard documents we generally work with as banking lawyers doing your deals, and therefore what you are likely to see if you're ever dealing with financing your project.
Thanks, Kendall. So hopefully the following documents are fairly familiar to you, or you've heard about them, or if not, you'll know all about them after today's session. The main point to take away is that all these documents link back to the core feature of project finance, the limited recourse nature of the structure, which I'm sure you can guess by now. Together, they're designed to give the lenders confidence that even with limited recourse, the project can support and repay the debt. So, firstly, we've got the facility agreement. The facility agreement is the loan document which sets out the terms on which the lenders provide funding to the project. This sits at the centre of the financing and is built around the financial model I discussed earlier, the contract that governs the loan and sets out the core commercial terms. These terms could include or will include the amount of debt being provided, interest, fees, repayment mechanics. You've got financial covenants. These will typically be focused on the project's future and historic ability to service debt as determined by the financial model, as well as details of required bank account controls. For example, recording where project income is to be paid. The facility agreement will also include a detailed set of undertakings and restrictions on what the borrower can and cannot do during the life of the financing. These are particularly important in project finance as lenders are relying, entirely on the project remaining within an agreed risk profile over the long term. Next, we've got the security documents. So alongside the facility sits the security documents. The precise security package will differ from project to project and depends on a number of factors, including where the project is located, for example, if it's in Scotland or in England and Wales, the type of asset being financed, the contractual structure of the project, and the project's overall risk profile. Generally speaking, we would expect to see a UK project finance security package to include the vast majority of the following documents. So we've got a floating charge over all assets, standard security or legal mortgage over any land or project site leases, assignations and security of key project contracts and insurance policies. You've got fixed security over bank accounts, security over shares in the project company, security over intergroup loans, and to the extent possible, you can also have fixed security over key movable assets, such as wind turbines. In most cases, the security package is kept within the project company. However, as Kendall highlighted when running through the structure chart, the hold company does grant some security. This is often in the case, or almost always in the case, of security over its shares in the project company and perhaps security over intergroup loans. Bank account security is utilized more often in project finance compared with traditional financing. Security over the project's bank accounts allows lenders to control cash flow and protect their debt position. Typically, this involves blocked accounts or controlled accounts, which sit alongside an operating account. Lenders will have visibility and control over how funds are applied throughout the lifetime of the project via these accounts. Next, we've got direct agreements. So, direct agreements sit alongside the security package and they give the lender a direct contractual relationship with key project counterparties, such as the main contractor. This provides lenders with additional comfort, particularly on an enforcement or default scenario, because it gives them standstill rights, step-in rights, and notices of key breaches. In case helpful, standstill rights prevent a key counterparty from terminating its contract for a short period after a default. This gives lenders time to decide how to protect the project, while step-in rights allow lenders to take over themselves or to nominate a third party to take over the contracts to fix the default and preserve the project. Finally, we've got intercreditor arrangements. So, intercreditor arrangements or subordination deeds regulate the relationship between different creditors. As a starting point, senior lenders will rank ahead of shareholders and subordinated creditors, as Kendall explained earlier. Where there is more than one lender or secured creditor, an intercreditor agreement, apologies, will determine who gets paid what on insolvency. These documents also regulate payments and decision making while the project is operating. So hopefully you now have a clearer understanding of what project finance transactions look like, the parties involved, how it is structured, and the key documents that underpin it. Before we bring the session to a close, we wanted to leave you with three key takeaways. Firstly, project finance is about lending to the project, not the sponsor's wider group. Lenders are repaid solely from the project's cash flows, with their recourse largely limited to the project company and its assets. Structuring is everything in project finance. Secondly, lender comfort comes from the structure and also from the security granted over the contracts package. Because lenders rely on the project's cash flow, they focus heavily on the financial model, due diligence, and the strength of the key project contracts. These documents allocate risk and underpin the project's ability to service its debt. Lastly, sponsor equity sits behind the senior lender's debt and is exposed first if the project underperforms. This helps align the interests of the sponsors and the lenders and supports the long-term viability of the project.
Thanks so much, Darnay. So that brings us to the end of today's session. If you'd like to hear more about any of the topics covered today, or if you have any specific queries for us, please do just reach out to one of the team, and we'd, of course, be delighted to hear from you. I popped our details on the slide here. As discussed, our session today has been recorded, so you'll receive an email with a link to the recording of the session by early next week. Our upcoming sessions are shown on the slide. Our next session will be corporate criminal liability, economic crime, management risk, which will be on the 6th of May. Please do use the link provided to check out our next session and book your spot in advance. Thanks again very much for joining today's webinar, and we look forward to seeing you at our future sessions.